everyone, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to talk about a checklist, specifically a trade entry checklist. So we've gone over a few checklists in the past. If you miss any of the checklists, my tip is to click on the magnifying glass at the top right corner and just type in checklist, and the results you'll see are going to be segments where we've talked about entry checklists, exit checklists, all kinds of checklists. So if you're a checklist type of person, definitely check that out. But for today, we're going to talk about specifically trade entry. So when I think of trade entry, if we go to the next slide, I'm going to show you some things that I look at when I'm looking at placing a trade. So the very first thing is going to be IV rank and IV, followed by liquidity. And I'm also going to determine what my assumption is on that underlying. Am I bullish, bearish? Do I have a neutral assumption? I'm also going to check for binary events. And really, we're looking at earnings announcements here and dividends. And also, last but not least, strategy. So what sort of strategy am I going to deploy for that certain underlying? So we've got the overarching themes here, but we're going to break into each one of these. So let's start with IV rank and IV on the next slide. So IV rank and IV, as you may know, when we're looking at strategies to trade or underlyings to trade, we're going to separate our strategies based on high IV environments and low IV environments. So to put it simply, when IVR is high and the option prices are high, we're going to be looking for credit strategies. So any type of trade where I'm selling an option or selling a spread, regardless of the direction, when IV rank and IV are high, for us, it's going to be best to be selling premium there because we're going to look for volatility contraction. So we know that volatility has been shown to be mean reverting. So if it's at a peak, it usually comes back down. And if it's at a trough, it usually comes back up. So when we're talking about high IVR and high IV, if I sell option premium when it's at its largest, as you can see by this balloon here, if I get a contraction, that will allow me to buy it back for a lower price, which will result in profit. On the flip side, if I have a low IVR environment, I'm going to be looking for debit strategies. So anything from calendar spreads to diagonal spreads, even directional debit verticals, I'm going to be looking for a low IVR environment for those strategies because a volatility contraction, where implied volatility actually increases, will be the result of option prices increasing, which is going to allow me to sell that spread or trade back for a higher price, which allows me to redeem profitability there. And one thing I want to point out is to always check the implied volatility itself. So the first thing I'll look at, if I'm looking at Dow, I'll pull up the grid page and I'll sort implied volatility rank from highest to lowest. So I'll get my high IVR situations and underlyings there, but I'm going to want to dig into the actual IV. Ryan and I did a great segment on this for his webinar segment. We actually talked about the difference between high IV rank and IV. So IV rank just takes implied volatility and plots it over a certain amount of time, gives you the high and the low. But what's important to note is that if the high and the low are very close to each other, it's going to give us still that 0 and 100 IV rank, but we want to make sure that we have a pretty wide range of implied volatility itself if we're looking for that contraction or expansion here. So definitely check that segment out if you'd like, and we can get into some more IV studies later. But for IV rank and IV, essentially, when we're looking at a high IVR or high IV situation, we're going to be looking at credit strategies, and for low IVR situations, we're going to be looking at debit strategies. So let's move along and we'll talk about another aspect of the trade entry checklist for me, which is liquidity. And this is one of the most important things just to get in a trade or out of the trade and also obtain that fair market price. Liquidity is king for us. So first and foremost, we're going to look for a narrow bid-ask spread. So what we like to consider narrow is a 10-cent wide or less spread. So SPY, if you look up SPY, which is the S&P 500 ETF, it's one of the most liquid underlyings out there, and there's hundreds of thousands and millions of underlying shares traded there. And also, when you look at the actual strike price for the options, there's tons of options traded there as well. So what we're looking for is a very narrow bid-ask spread. And from this visual, basically we're looking for an agreement on the price between option buyers and option sellers. So With SPY specifically, it's usually about a 1 penny or 2 penny wide market, which is as liquid as you can get. Additionally, we're looking for shares to be over 1 million. So if I'm just looking at the raw shares of an underlying, I want to see over 1 million shares traded per day. And if I'm looking at an option strategy, I'm going to be looking specifically at volume and open interest. So with volume and open interest, I would like to see the volume and open interest above 1,000 ideally per strike. So each strike is going to have a different volume and different open interest, and the strikes are even going to vary between the expirations. Usually the most liquid expirations are the normal expirations, which are the third Friday of each month, but it can vary, especially around earnings announcements. But one way you can check this out in Doe is if you have the trade page opened up, if you single click on call or put in the singles menu right next to the strategies menu, when you hover over the strikes within the trade page, right above that trade page you can see a You Are Here section, and that's where you'll see open interest and volume for when you're comparing different strikes and different expirations. So definitely check that out if you haven't already. So this is what I'm looking for with liquidity. Let's move it along and we'll talk about the next aspect of trade entry. So one thing I want to make sure is what my assumption is. So I might find an underlying, I might figure out it's got high IV or low IV, figure out that it's pretty liquid, but now I need to decide what I want to do with that underlying. So do I have a bearish assumption, or do I think the underlying will go down? Do I have a neutral assumption where I think the underlying will stay within a specified range? Or do I have a bullish assumption where I think the underlying will go up? So I need to make that decision for myself, and whatever reasoning I might have, we've got strategies, high probability strategies to back those up. But first and foremost, I'm going to check my assumption and figure out what that actually is. Additionally, when I'm looking at the price of the underlying, let's say the underlying has spiked up 10 or 15%, or it's gone down 10 or 15%. I need to determine, was this post-earnings? Was this something that came out from an earnings announcement where maybe it will creep back up? So let's say, for an example, with LinkedIn or Chipotle, anything, when the underlying spikes down or spikes up, usually we can see over a period of time that it may come back, it may not. So we have to make that assumption for ourselves. Or is it a natural price extreme like you might see in some commodities right now? So with that situation, what we're looking at is the pot odds of the situation. So with the commodities, here pretty much long most of them, and that's because we believe the pot odds are to the upside. So when I look at an underlying that's been beaten up over the past year or 2 years, I'm basically looking at myself and saying, do I think this is going to continue to go down, or does it have a better chance to reverse and go back up? So for us, with commodities specifically, we think it's going to go back up. So we take the pot odds side, and that's why we are long for most of these. So I want to figure out my assumption, but there's also some other things. So let's go to the next slide and we'll continue the discussion here. So another thing to keep in mind is binary events. And specifically, we're talking about earnings and dividends. So with earnings, we want to determine whether we're placing an earnings play in an underlying or whether we're not. So if we have an earnings play, sure, we can sell premium a day or during the day or a couple of days before if we believe it's going to stay right there. And if that's our play, then sure, we can make an earnings play. But one thing we want to be aware of is when that earnings announcement is. So if I've got an earnings announcement in 35 days, but I sell an option that's going to expire in 45 days, I'm making it hard on myself to reap those profits because of the fact that we've shown that implied volatility tends to creep up the closer we get to earnings. So if I'm selling premium and I'm looking for that theta decay, if implied volatility is increasing while the theta decay is supposed to be decreasing the option, it can pretty much result in a wash, and it's going to be hard for me to see that profitability that I'm looking for. So it's important to know where the earnings announcement is and whether or not I want to avoid that or use it for an earnings play. And I also want to be aware of a dividend. So a dividend is essentially a distribution of cash for shareholders, but with in the money calls, it can put us at risk for early assignment. So I just did a whiteboard on that a few days ago, so if you missed that, definitely check it out. But with dividends specifically, we want to make sure that if we have in the money options, in the money calls specifically, we want to make sure that we're aware of that and we can roll the position or get out of it before the dividend is released or before the ex-dividend date to make sure we're not in that early assignment risk pool. So we've got one last thing to discuss, and that's going to be on the next slide here. So we'll discuss the strategy. So this is crucial and very important, but there's a few things I want to talk about with strategy. So I might have figured out my assumption, I've got an underlying, everything's good to go, but now I need to take a look at my situation personally and figure out what sort of strategy I'd like to deploy. So the first thing I'd probably look at is trade size. So we like to keep our trade size very small. You might have heard trade small, trade often, and that's because we don't want to put ourselves at risk for any outside movements or any binary or black swan events. So let's say I've got a trade size on that's taking up 30% of my portfolio and it goes against me. I don't want to put myself in that situation. So we aim to place trades that are under 5%, closer to 3% or less of our total portfolio. So if I've got $10,000 in my account, that means that for an initial trade, I'm looking for $300 or less in initial buying power reduction. That would be 3% or less. So it's something to keep in mind. It's going to vary from person to person because everyone's got a different account size, but it's certainly important to keep in mind. The next thing I want to make sure is whether I'm placing a credit or debit strategy. So again, in high IV environments, I might be looking to sell premium, which is going to be a credit strategy. Or in low volatility environments, I might be looking for a debit strategy, which is going to be ideal for those low IV environments. That's going to be a debit trade. And last but not least, I'm going to assess my own risk profile. I'm basically going to ask myself, am I comfortable with selling naked options if I'm selling credit trades, or do I want to turn those into spreads and define my risk, which would essentially reduce my max profit and probability of profit, but if I'm more comfortable doing so, then I certainly can. So let's get to some takeaways here and we'll wrap it all together. So as you can see, there's a number of things we look at before placing a trade, whether it be liquidity, our assumption, whether there's any binary events. There's a ton of different things, but really our main concerns are going to be liquidity, IV rank, and our assumption. So like I said, liquidity is king. We don't trade anything that's not liquid because we want to be able to get in whenever we want, get out whenever we want, but also at a fair price. And those liquid underlyings are going to give us just that. IV rank and IV are going to be second on the list, and that's just because we want to be sure that we're taking advantage of those high IV environments and selling premium into those. And also just trading high IV rank underlyings, there's a lot of fear involved with those underlyings, which is what we love to do. And we're also going to take our assumption into play. So am I bullish on this underlying? Am I bearish? Or do I have a neutral assumption? We've got strategies for each of those, so definitely check those out. And our final thoughts are going to be the specific strategy selection and binary avoidance. So if I don't want to place an earnings trade, I'm going to make sure that whatever strategy I choose, if it's a 45-day to expiration option, I'm going to make sure that the earnings announcement does not fall within that range. And also, I'm going to just be aware of dividends because in-the-money calls, short in-the-money calls specifically, can be at risk for early assignment if the extrinsic value in those calls is less than the actual dividend. So this has been my trade entry checklist. We've got a bunch of others. So again, if you've missed any of the others, type in checklist, you'll see them all there. Hopefully you enjoyed this though. If you've got any questions at all, shoot it over to support@dough.com, support.com, or you can tweet us at doughtrading, at doughttradermike, or at. We'll be off the rest of the week, so have a great holiday week, everyone, and we'll be back on Tuesday.
Hey everyone, thanks for watching. If you liked this video, give it a thumbs up or share with a friend. Click below to watch more videos, subscribe to our channel, or check out our website.